In the last monetary policy, Reserve Bank did not raise the repo rate, and chances are it won't in the October policy either. But it is expected to keep the liquidity tight in the banking system. Now, what is liquidity in the banking system? That's what I'm seeking to explore today. For this, we have to start with what is the repo rate. Well, banks can't be sure exactly how much people may withdraw or deposit on any day. So on a daily basis, banks borrow from one another for a one-day period in the call money market. Now, if the repo rate is 6.5%, Reserve Bank will ensure that banks borrow from each other at 6.5% rate. If the call market doesn't have sufficient liquidity, then Reserve Bank provides money to banks against securities at its MSF window at 25 basis points higher than the repo rate, that is at 6.75%. And if there is too much liquidity and no takers in the call market, then Reserve Bank provides an SDF or standing deposit facility where banks can deposit surplus money at 25 basis points below the repo rate, that is at 6.25%. Now, thanks to the SDF at the lower level and the MSF at the higher level, Reserve Bank ensures that the call rate stays between 6.25 and 6.75%. Though its mandate is to keep the call rate at 6.5%. Now, how does liquidity rise or fall in the banking system? The amount of liquidity is mostly determined by Reserve Bank. When Reserve Bank sells Government of India bonds, it absorbs liquidity from banks. That is, it tightens liquidity. Now, if Reserve Bank wants to increase liquidity, it buys bonds from the market and thus injects cash. Alternatively, when Reserve Bank sells dollars, it absorbs liquidity. Likewise, when it buys dollars, it injects rupee liquidity into the system. This liquidity is also called net durable liquidity. Now, the other agent that can impact the net durable liquidity is you and me. When we deposit cash, we are increasing the durable liquidity. When we withdraw cash from banks, we reduce the net durable liquidity. That is why liquidity normally tightens during festival seasons like Diwali, because people are withdrawing money to spend. Now, there is another less used instrument through which Reserve Bank can reduce the liquidity. It can increase the cash reserve ratio, CRR, which means a percentage of the deposits that banks have to keep as idle cash with the Reserve Bank. In the monetary policy on August 10th, Reserve Bank had announced an incremental cash reserve ratio to take out liquidity up to 1.1 lakh crore rupees. Reserve Bank said it wanted to take out the excess liquidity created by people depositing 2,000 rupee notes in banks. However, most experts knew RBI wasn't just removing liquidity created by the 2,000 rupee deposits. RBI generally wanted to tighten liquidity because inflation had shot up to 7.4% in July, and Reserve Bank wanted to push up the interbank call rate closer to the MSF rate of 6.75 so that banks slow down their lending. Thus far, we saw what is durable liquidity. Now, there are frictional or temporary factors which lead to an increase or decrease of the banking liquidity. This is mostly government spending and tax payments. Liquidity falls sharply on advance tax payment days. 4 days in the year: June 15, September 15, December 15 and March 15. On these days, liquidity tightens sharply as money moves out of the banking system into government coffers. But usually, in a month or so, the money returns when government starts spending the tax money. Liquidity also tightens slightly on certain days of a month when GST or excise duties are paid out. RBI helps banks tide over these days by providing money through what is called variable rate repos. That is, it auctions money for 14-day periods or 7 days or sometimes even 3 days. Alternatively, if there are periods of surplus liquidity because of temporary factors like government has spent too much, then Reserve Bank absorbs it from the banks through variable rate reverse repo auctions, VRRR auctions. Now, Let us go back to the daily setup that we described earlier. Normally, banks meet their liquidity needs from the call money market by borrowing from other banks at the repo rate. On a given day, if there is less liquidity in the banking system, banks can borrow from Reserve Bank in the MSF window. Alternately, if there is more liquidity, there are no takers in the call market, banks can lend that surplus to Reserve Bank at the SDF window. This we already know. Logically, therefore, there should be no bank using MSF and some of them using SDF on the same day. The SBI economist Soumyakanti Ghosh, however, points out that this is exactly what has been happening. He and his team have looked at the banking system liquidity from April 2022, almost 18 months, and found that for 247 days on which liquidity was deficit. But even in those days, on an average, banks have been depositing an average of 76,000 crores in the SDF window. Now, why would banks do that? On those 247 days, other banks have borrowed on an average 39,000 crores from the Reserve Bank through the MSF window. Why didn't banks with excess cash lend to banks with deficits in the call market? Dr. Ghosh replies, this is because of the rapid growth of transactions throughout the day through the NEFT and the RTGS. The call market closes at 2:30 p.m. What if there are sudden payment requirements from depositors after 2:30 p.m.? Banks therefore prefer to keep the surplus in the SDF window so that they can withdraw it. Dr. Ghosh therefore argues that the RTGS and the NEFT demands have led to an amount of money that banks deliberately keep idle. This cautionary surplus he calls unusable liquidity. Ghosh suggests that Reserve Bank can reduce the amount of unusable or enforced liquidity by keeping the call market settlement open up until say 5:30 p.m. These deals are settled by the Clearing Corporation of India or CCIL. Ghosh wants the CCIL clearing to be open till 5:30 p.m. instead of 2:30 p.m. currently. Now, to come back to where we started, what will Reserve Bank do in its October 6 monetary policy? Most bankers see no change in the repo rate, but it is possible Reserve Bank may continue to keep liquidity tight by selling small amounts of bonds or through the variable rate repos. Reserve Bank mostly doesn't want too much liquidity chasing goods till inflation decisively moves closer to its 4% target.